You know that feeling, right? The fear of a market crash, that pit in your stomach when you think about waking up and seeing your investments just gone? It's a pretty universal anxiety. But what if I told you that history gives us a kind of playbook? Turns out, major crashes don't just materialize out of thin air. There are warning signs, 4 specific patterns actually, that tend to show up again and again right before things go south. And understanding them, well, that's the key to seeing what might be just around the corner.
So that's the million-dollar question, isn't it? Can we really see a market crash coming? The answer isn't in some crystal ball. It's in something a lot more reliable: history. Because when you look back at the biggest crashes, you don't just see chaos. You start to see a blueprint. You see a pattern of human behavior that just keeps repeating, giving us some pretty powerful clues about the future.
And believe me, the stakes could not be higher. During the Great Depression, the market didn't just dip. It collapsed by an unbelievable 89%. Now, that's not just a number on a chart. That's lives, homes, and futures completely wiped out. So yeah, understanding these patterns isn't just some academic exercise. It's about being prepared. Let's dive into the very first one.
Okay, so our journey starts long before Wall Street or supercomputers. We're going to have to go way back to the 1600s. We're heading to the Netherlands to uncover the very first, and maybe the most dangerously human of all these patterns: investor overconfidence.
So to really get what happened, you have to picture the scene. This was the Dutch Golden Age. I mean, wealth was flooding the country. They had just invented the world's first stock market. Confidence was through the roof. And right in the middle of all this excitement, a simple flower, the tulip, became the center of the world's first ever documented market bubble.
This is where it gets crazy. At the absolute peak of this mania, a single rare tulip bulb could sell for more than 5 years' worth of an average worker's salary. Just let that sink in. An amount of money that could buy you a nice house was being spent on a flower bulb. People weren't buying them because they were pretty. They were buying them because they were absolutely 100% certain someone else would pay an even more insane price for it tomorrow.
And this quote, it just perfectly captures the mood. When a writer actually published a pamphlet trying to warn people about the bubble, a tulip grower's response was basically, relax, don't worry about it, have a drink. They were just intoxicated by the profits, completely blind to the risk, because the money felt too easy, too much of a sure thing.
And that right there, that brings us to our first pattern: rampant speculation. This is what happens when an asset's price gets totally disconnected from its actual real-world value. The thing you're investing in almost stops mattering. The only thing that matters is believing that there's always a greater fool out there who's willing to pay more than you did.
Okay, now let's see how this idea evolves. We're going to jump forward a few hundred years, all the way to the Roaring '20s in America. This era shows us our second critical pattern: what happens when the rules of the game just can't keep up with the players.
You see, regulation is a really delicate balancing act. Before the '29 crash, everyone remembered the panic of 1907. Back then, regulators came in so hard and so late that they actually made things worse and helped cause the collapse. So by 1929, the pendulum had swung to the complete opposite side: do almost nothing. And as it turns out, both extremes are really, really dangerous.
And the fuel for this 1920s fire was debt. A new financial product, the so-called leveraged investment trusts, just exploded onto the scene. Basically, they let everyday people buy stocks with borrowed money. Now, when the market was soaring, this made them feel like geniuses, multiplying their gains. But it was a time bomb, because when the market turned, it was going to multiply their losses just as brutally.
And if you want to know what the government was thinking, this quote from President Calvin Coolidge just says it all. It was a laissez-faire, or hands-off period. The economy was booming, the bankers were making a killing, and nobody in power wanted to rock the boat, even as the whole system was getting dangerously unstable right under their noses.
So there you have it. Our second pattern is regulatory shortcomings. This is what happens when the financial world innovates faster than the rulebook can keep up, or when the people in charge either do way too little, letting a bubble get out of control, or they do way too much and end up popping it themselves. It's a really dangerous tightrope to walk.
All right, let's jump ahead again. This time to the era of big hair, big shoulder pads, and, well, big greed, the 1980s. This is where we find our third pattern. And this one is one of the trickiest to spot, because at the time, it always looks like pure genius.
The hot new innovation was something called portfolio insurance. With computers becoming more powerful, banks created these really complex algorithms that promised to be like a seatbelt for your investments. The idea was, if the market started to drop, the computer would automatically make little trades to protect you from losing money. It sounded absolutely foolproof. What could possibly go wrong?
Well, it wasn't foolproof. On October 19, 1987, a day we now call Black Monday, the market had the single worst day in its entire history. The Dow just cratered, dropping over 22% in one single day. The very tool that was designed to protect everyone became the main reason for the crash.
And this leads us right to our third pattern: poorly understood innovation. You see, the fatal flaw was that nobody stopped to think, hey, what happens if everyone's portfolio insurance program starts selling at the exact same moment? Those small protective sales all triggered at once, and it turned into a selling avalanche, an unstoppable cascade that the creators just never saw coming.
For our final pattern, we come to a crash that a lot of us probably remember all too well, the 2008 global financial crisis. And this one reveals the ingredient that's like pouring gasoline on the fire of those other three patterns.
The road to 2008 was literally paved with cheap money. After the dot-com bubble burst, the Fed kept interest rates super low, which made it incredibly easy to borrow money. This kicked off a massive housing boom. Banks then took these mortgages, even the riskiest, subprime ones, and bundled them into these super complex products they sold to investors all over the world. And it was all based on one critical and totally flawed assumption, that housing prices would never, ever go down.
And that right there is our fourth and final pattern, a massive buildup of debt. When everyone, from regular home buyers all the way up to the biggest banks on Wall Street, is leaning heavily on borrowed money, the whole system becomes incredibly fragile. It's like a house of cards. The smallest crack, like housing prices starting to fall, can bring the whole thing crashing down.
So, okay, we've walked through history. We've identified these four recurring patterns: rampant speculation, regulatory shortcomings, misunderstood innovation, and a huge buildup of debt. But the real question is, so what? How do you turn all this historical knowledge into a practical playbook that can actually protect you today?
Well, here's a simple checklist you can use. Think of it as your personal crash-spotting toolkit. When you look at the market, just ask yourself these four questions. Are people buying things just to flip them for a quick profit? Is there a brand new market popping up with basically no rules? Is there a new can't-lose product that seems way too good to be true? And is everyone borrowing money to get in on the action? These are your big, flashing warning signs.
So let's say you feel a downturn is coming, or maybe we're already in one. What's the playbook? Well, first, let's talk about what not to do. Don't panic and sell everything and run to cash. Inflation will just eat away at your savings. And definitely don't try to perfectly time the bottom. Even the pros almost never get that right. The real key here is a mindset shift. You have to start seeing a crash not as the end of the world, but as a sale. For a long-term investor, a market crash is a massive opportunity to buy great assets at a huge discount.
You know, there's that great Mark Twain quote, and it's just the perfect way to wrap all this up. The next crash won't be about tulip bulbs or weird computer programs. The details are always going to be different, but the underlying human behaviors, the greed, the fear, the overconfidence, you can bet those are going to rhyme with the past.
Which brings us to the final and maybe the most important question. I'm going to turn this one over to you. Using these four patterns we've just talked about, take a look at the world around you. Look at the headlines, the new technologies, the new investments everyone's talking about. Where do you see history rhyming?